One of the most common questions I get has been posed here by Sean, but I get this all the time. As you know, I trade multiple strategies and I'm a big believer in strategy diversification. Most people will suggest that you have a diversified stock portfolio. Well, I just do it with strategies, that's all. And my goal here is to have different strategies in different market types, trading different styles and different time frames. So I guess the key takeaway, for me at least, is strategy diversification, and that will depend on three things. So it will depend on the amount of capital you have available. Obviously, if you have limited capital, then commission drag starts to become more of an issue, especially with shorter term strategies, so it may not be appropriate. If you've got limited capital, you can probably trade lower frequency strategies, say something like the ASX momentum and the US momentum. That way you get diversification into two different markets, and they're low frequency kinds of strategies, so commission drag and frictions will be very limited. So the first thing is available capital. The second thing is available time. Obviously, if you have a busy family, you've got a career, or you do a lot of traveling, then day trade strategies, for example, or systems that need to be operated daily may not be appropriate for that, and it may well be that you select a weekly program such as something like the Weekend Trend Trader, or a monthly program like the ASX Momentum or the US Momentum. So that's the second thing. The third thing is market accessibility, and it could be that your broker doesn't facilitate certain order types. For example, my day trade strategy requires an API, it requires connectivity, and certainly in Australia there's really no brokers that allow that kind of stuff to happen. So if you use a very basic kind of broker, then trading those kinds of strategies won't be able, and therefore you either need to change broker or look at a different kind of a strategy. Same thing if you have a strategy that uses stop loss orders. You may use a broker that doesn't facilitate stop loss orders, so you either have to change brokers or you need to change strategy. So as a basic to answer this question, the basic suggestion from me would be, look, 50% allocation to the ASX, 50% allocation to the US, and if you're new to it all, just use very simplistic kind of strategies. I can't stress that enough. A lot of people come into trading with visions of grandeur and all sorts of stuff, but you know, after a month or two, the daily workload becomes too much for them. They don't have the discipline to stick to it. So if you trade a monthly strategy like the US Momentum or the ASX Momentum, you can literally just put it in your calendar and forget about it for the whole month. There's nothing to do intra-month. Put it in your calendar. You get the wake-up call at the end of the month, run the orders, place them, and away you go. So that would be the very basic kind of example there. Now, in terms of me personally, we'll just move forward to my... So this represents about 70% of my full exposure to the stock market. We do have a strategic portfolio that holds positions in certain strategic companies for a long term. We've had positions, some of those positions for up to 20 years, but that's not included in these numbers, and that represents about 30% of the total. So the rest of the trading portfolios is about 70% of our exposure to the stock market. Now, you can see here that the ASX is a little bit heavy on the longer term strategies, growth portfolio, ASX Momentum and Weekend Trend Trader, and that's because a lot of that money is actually our super fund, and therefore we're limited to what we can actually do with that. Short-term trading in a super fund is not overly appropriate. The ASX Momentum doesn't operate in the super fund, but both the growth portfolio and the Weekend Trend Trader do, so that represents about 28% of that total. So the country split there is about 50-50, In terms of style, I'm a little bit short still on the short side of things. I've only got 17% allocated to short-term trading, and that would be our high frequency strategy and the day trade strategy. It's my intention to double the allocation to the day trade strategy in the next drawdown, but at the moment I'm at new equity highs there, and it's cruising along pretty good. So I just want to wait for a drawdown of around 10 to 12%, which will come. And at that stage, I'll reallocate or reweight some of that money into the day trade strategy. So 50-50 more or less in the country allocation. In terms of the style, 17% only to short term, 28% to absolute trend following, and relative momentum about 55%. Now the trade long term portfolio there is quite heavily weighted, and that's because last year that portfolio returned 97%. So I think we're up about 26% this year in that portfolio, so that needs to be rebalanced. I actually should have rebalanced at the start of this year, but so be it, that needs to be done. And as I said, we're going to increase the allocation to the day trade strategy there. So 3 different styles of strategy, and the time frames, 33% are daily operational. The growth portfolio, for example, is daily operational, but that doesn't mean I do anything on a day-to-day basis. We can hold positions there for quite some time and not do anything in any way, shape or form. So the weekly strategy is 24%, monthly allocated 43%, and again a lot of that is that trade long term, which operates both on a weekly and a monthly time frame. And if we even break it down further, if we look at the ASX there, so the growth portfolio basically trades the industrial stocks outside of the ASX 100. The ASX Momentum only trades the ASX 100 stocks, and the weekend trend trader is calibrated to trade smaller cap stocks really outside the ASX 500. So I'm getting a good spread across the whole market there, big caps, intermediate caps, and the very smaller caps as well. So what we're doing here is diversifying across everything, and the concept is that, look, not every strategy is going to work perfectly well all of the time, but over the long term, all these strategies have very, very good return metrics. So it's just a matter of allowing them to run their course over the long term. And in the short term, there's going to be some ups and downs. To give you an example, the trade long term portfolio, as I said before, last year made a return of 97%. And then we went into a pretty stiff drawdown earlier on this year. I think we were down at some stage there about 25%. And we're now up 26%. So they're just the swings and roundabouts of that kind of trading. And the whole idea of putting them all together is some will do poorly at certain times of the year, others will do very, very well. The day trade portfolio, for example, it's up 40% year to date. So it's offset what's going on with the trade long term, and same with the US Momentum. It was actually performing really, really well at the start of the year, whilst the trade long term portfolio was performing poorly. So the whole idea is to keep the equity curve moving and not being reliant on a single strategy. What we tend to find, if someone relies on a single strategy that goes into drawdown, then they become quite disheartened and can tend to drop it or switch to something else. And portfolio or performance chasing is a very common error that a lot of people make. And by trading multiple strategies, you kind of alleviate that to some degree. So that's a bit of an idea of how I split our money up. As I said, this represents about 70% of the funds that we have allocated to the stock market, and the other 30% is in our strategic portfolio. So I hope that's helpful, and happy to answer any other questions.